Good afternoon, everyone. I'm Piyush Bhandari, your accounts teacher. Today, I'll be continuing the same topic which was started in the last class, and that was Introduction to Accounting. Today's presentation will be focused on a recap of what was taken up in the last class, and then functions of accounting will be taken up, advantages and limitations will be taken up. After that, accounting process and branches of accounting will be undertaken. So let us take up whatever was started in the last class. It was accounting. It was introduction to accounting. What is accounting? Accounting is a systematic process, which is governed by certain rules and regulations and principles and concept. And process consists of certain interrelated activities to do something, and those activities are identifying the transactions, and that too the financial transactions, because there are financial transactions as well as there are non-financial transactions, and in accounting only the financial transactions are undertaken. So the financial transactions are identified, that is, they are recognized, and after that their economic value in terms of money is measured. If the goods have been purchased by the owner, so the transaction will not be simply purchase of goods, but its monetary value will be measured, that is, what is the cost of the goods at which they have been purchased, whether 10,000, 15,000 or 20,000. And then as soon as they are measured in monetary terms, they are recorded in the books of accounts. They are written in the chronological order in the books of accounts as they have taken place or they have happened. Now, after recording and writing all the financial transactions in the books of account, which is called journal, then they are classified. That is, similar kind of transactions, they are put into their relevant groups. That is called classifying. After that, towards the end of the year, all the transactions, they are summarized in order to ascertain whether the business has earned profit or loss. That is called summarizing. In summarizing, not only the profit or loss is ascertained, but also what is the financial position of the business, that is also depicted. After ascertaining profit or loss and depicting the financial position of the business, every aspect of this financial information is analyzed, is studied in depth to find out the various opportunities and possibilities for further improvement in the future. And analysis is done in such a way so that it could be presented in a simple form, in understandable form to the others. This is called interpretation. And after that, it is communicated. What is communicated? That is, financial informations are communicated. They are informed to those who are the users of the financial information. So this was the meaning of accounting. This is the basic meaning of accounting, and on this meaning of accounting, the whole accounting relies. And this meaning itself gives all the features also. So the features of accounting which were undertaken in the last class were: number one, identification of financial transactions, then measurement of the financial transactions, after that recording, then classifying, after that summarizing. The next step was analyzing and interpreting, and the last step was communicating the financial information to the users. So today we start with the functions of accounting, and the first function of accounting is maintaining systematic records of accounting. That is, maintaining systematic accounting records. This function is the base function. This function is the primary function of accounting, in which all the financial transactions, they are recorded in a systematic way in the book which is called journal, and another book where the classification is done, that is called ledger. And after that, the second step comes, the second function comes, that is preparation of the financial statement. In the first step, recording and classification comes, whereby that's why it is said that maintaining systematic accounting record. After recording, next comes to prepare the financial statements. Another major function of accounting is to prepare and maintain the financial statements. Now, what are the financial statements? Financial statements are the statements which are prepared at the end of the financial year or 1 year, and the financial statements are not only calculate and ascertain the profit or loss of the business, but also depicts the financial position of the concern. And there are two types of financial statements. One is income statement and another is position statement. The synonym name for the income statement is trading account and profit and loss account, and the synonym term for the position statement is balance sheet. Trading account and profit and loss account is prepared to calculate profit or loss, and position statement is prepared to depict or to show the financial position of the business in terms of assets and liabilities. Assets are those things which are owed by the business, and liabilities are those which a business is required to pay to the outsiders. So, on the basis of the systematic record, the business organization prepares the financial statement, and these financial statements are of a great importance for every business organization. The third function of accounting is meeting legal requirement. Meeting legal requirement means there are certain requirements which every law wants to be fulfilled by every business organization, and in that first comes the law of tax. That is, there is a tax which is to be imposed by the government on every business organization's profit. So the business organization is supposed to pay the tax which is the requirement of the law, and this requirement of the law is met by the accounting. Since the accounting prepares the record in a systematic way, calculates its profit and loss, and depicts the financial position in a systematic way, by this the authentic and reliable information is provided. On the basis of that information, the legal requirements are fulfilled by accounting. Now the next function is communicating the financial information. This is another function, and which is very important function of the accounting, that is to communicate the financial information to the users. There are internal users, there are external users. Internal users are the owners, employees and the management, and the external users are government, financial institutions, banks, suppliers, creditors, researchers. These all are the users of the financial information. So accounting provides reliable and authentic information, and that to the financial information to these users. Now, the last function of accounting is assistance to the management. Now, management also requires financial information which is provided by maintaining the record, which in turn helps the management in taking a number of decisions. Accounting records are maintained in such a manner that everything becomes clear, every aspect becomes clear for the management to take a number of decisions in the future. So these were the functions of accounting. Now let us move to the next concept, that is the advantages of accounting. There are a number of advantages, there are a number of benefits and merits which have been offered by accounting to those who need the information of the business organization. So the first advantage is financial information about the business. That is, the accounting provides financial information about the business. As we have studied in the last concept and topic also, that accounting provides systematic record of the financial transactions, of the financial performance in terms of profit and loss, and in terms of assets and liabilities, what is owed by the business and what is owned by the business. This is the information which is provided by the accounting. Now, the second one is assistance to the manager. The accounting information which is prepared in such an authentic and reliable way becomes a helpful tool for the management to take a number of decisions in the future, and those two decisions are related to the cost and the expenditure. It is the effort of every management or a group of managers to undertake every effort to minimize and reduce the cost, that is to reduce the expenditures. As the expenditures will reduce, the cost will reduce. So every management and every manager is interested in knowing from the accounting records that what are the different areas which require to reduce the expenditure and the cost. And this way the accounting provides the assistance to the management. The next one is accounting replaces memory. Accounting is very much helpful in providing the systematic records of the business, which may be referred from time to time, since records are available and any moment, any time, whenever any duration, any time's information is required, accounting provides it. Hence it is said that accounting eliminates the need to remember the transaction, because it is very difficult for an owner, for a business or businessman, or for a group of managers to remember all the transactions for a large number of years. Is it next to impossible? So for that purpose, accounting, since it maintains the records, those records are reliable, authentic, can be presented at any moment of time. So they replace the memory. Now the next advantage of accounting is it facilitates the comparative study. Accounting provides records. Now I hope this is clear to all of you. Since it provides record of the financial transactions, so whatever financial transactions are there, they become a reliable proof to have a good comparison. The first kind of comparison which is possible of the financial information is the comparison of one year with the another years. This is called intra-firm comparison. And if the businessman wants to compare its net result of the activities in terms of profit or a loss with other business net result in terms of profit and loss, so this is also possible, and this is also possible only with the help of the accounting, which helps in maintaining the systematic record. Hence, there are two types of comparison. One is intra-firm comparison, comparison within the organization, within the business of different accounting periods, of different years. And second is inter-firm comparison. Inter-firm comparison means the financial results when they are compared with the financial results of other business organization, and this is possible only by accounting, because accounting provides systematic, reliable and authentic financial information. Now the next one is facilitates loan. Facilitates loan. That is, accounting is very much helpful in raising the loan. Reason: whenever any business organization or a businessman contacts the bank or the financial institution for a loan, then they demand the financial information in terms of profit or loss and the financial position in terms of assets and liabilities. And this is provided, this information is provided by the accounting, and hence because of this it becomes easy to arrange loan from the banks and from the financial institution. Next is evidence in the court. Evidence in the court means at times an emergency may take place because of some dispute. If some case goes on in the court, some issue has been cropped up and the case has been filed in the court, so the court demands the financial records, and those financial records are presented in reliable and authenticative form to the court, which becomes an evidence, a documentary evidence, which is to be presented in the court. The issues can be any issues. Now, the last one is facilitates settlement of tax liabilities. Facilitates settlement of tax liabilities. Now, government and the law imposes tax on the profit which is earned by business organization. So it is the accounting, since the records are readily available, on the basis of the records, the calculation of the tax takes place and the payment of the tax, that is called the settlement of the tax liability, takes place by the records which are available of the accounting. So here advantages of accounting, they come to an end. Now let us take the next concept, limitations. Can there be possible that anything which has certain benefits, which has certain advantages to offer, may not have any limitation? Limitation doesn't mean that there are certain wrong things in accounting. No, limitation means that certain areas which are restricted to be considered by accounting, and such things limit the scope of accounting to some extent. So the first one is, accounting is not fully exact. Means accounting is not completely free from the personal bias or judgment. Although it is said that transactions are recorded on the basis of some documentary evidence, yes, no financial transaction is recorded without any evidence. But even then, in some cases, the transactions are recorded on the basis of some estimates. For example, the estimates for possible profits, estimates of the duration for which number of assets will be used. In making such estimates, personal judgments are required, they are needed. As there is no uniformity for making such estimates, the figures, the data of profit and loss vary if calculated by different persons. If 1 year one accountant is maintaining the accounting records, second year another accountant comes, so they will have their own personal judgments which will bring a change in the result. Hence it is said that accounting is not fully exact. Fully, completely exact is not there. Something lacks in this. The second one is, accounting ignores the qualitative elements. Accounting ignores the qualitative information. As accounting is concerned only with the monetary transactions, only with the financial transactions of the business, it generally ignores the qualitative aspect, like good relations between the employees, between the workers, good relations between the management and the workers. If there is a quarrel between two groups of employees, and this quarrel and a fight has brought the work to a standstill, because of this a lockout has taken place, there is a strike in the factory, the work has come to a standstill, the production has come to a standstill, there is no production, there is complete lockout, complete strike for 1 week. If in the factory the work was not done, so the goods will not be reached the market, there will be no sale. When there will be no sale, the sale will reduce. It has affected the performance of the business. But this is an activity. This quarrel is an activity, but this activity cannot be measured in terms of money. This activity has no economic value. So this is a qualitative transaction and activity. So this will not be considered. I hope this is clear. Here accounting becomes a limitation. The next one is, accounting ignores the effect of the price level changes. Generally, accounting statements, that is the financial statements, are prepared at original cost, at the cost at which they have been purchased or the goods have been purchased, and the value of money is bound to change from time to time. As a result, the figures, the data, the financial information which has been given in the books of account, it ignores the change in the price. For example, if a building has been purchased for 3 crores 5 years back, so in the books of accounts, the value of that building is written as 3 crore. 5 years back, a building was purchased for 3 crore. But today, if its value is 10 crore, so will the value of that building be written in the books as 10 crores? No. Its value will be 3 crore. So the statement, the financial statement is showing the value of the building 3 crore, but its present market value is 10 crore. The value, the price has changed, but our financial statement is showing the same price. So this feature again becomes a limitation of the accounting. And lastly, accounting leads to, it may lead to window dressing. What is window dressing? Window dressing means the practice of manipulation of accounts to present a more favorable position of the business, to have a good position in the market. Many business organizations and businessmen, they change their financial data than the actual position. If the profit of the business is 1 crore, in order to have a good image, the businessman has changed this 1 crore profit to 5 crore profit or 10 crore profit. By this, what has been done? Either the expenditures will be reduced in the books or the sale will be increased in the books. This is called manipulation of the financial information. So because of this, the true and fair view and image of the financial position and of the net profit or a loss will be prevented from the people, from the users of the financial information. Hence, this also becomes a limitation of the accounting. Now, let us do accounting process. As process is a series of interrelated activities to do anything. So, when we talk about accounting as a process, means a series of interrelated activities which are undertaken to ascertain the reliable and authentic financial information for the users of that information. So the first step of the accounting process is identifying financial transactions and events. I hope this is clear to all of you, as we have already discussed twice in the class, in the last class, that is identifying financial transactions and events. There are financial transactions and there are non-financial transactions. So the first step is, first of all, identify, recognize, highlight which are the financial transactions for the business organization, for the business. Second step, then measuring those identified transactions, those transactions which have been declared as the financial transactions, find out the monetary value, find out in terms of economic value or the money. This is the second step. The third step is recording. After that, on the basis of the documentary evidence, on the basis of a proof, on the basis of a source document, the recording takes place, that is, the transaction is written in the original book of entry, which is called journal. There are different kinds of journal. There are 8 kinds of journal. There is a cash journal, there is a purchase journal, sales journal, purchase return journal, sales return journal, bills receivable journal, bills payable journal, and there is proper journal. According to the type of the transaction, all the financial transactions are recorded in these all journals. Now, after recording, then from the journals they are posted to the next one in the ledger. That step is called classifying, that is called classification. Classification is making the similar kind of transactions into different groups. Different groups are made and they are called accounts. And those similar kind of transactions are put into the one. All purchase transactions, purchase of goods will be placed in purchase group. All sales, they will be put into sales. So this way, the groups are made in terms of accounts. So classification is done in a book that is called the principal book. The name of this principal book is ledger. So from the journal, when they are transferred to the ledger, which is a principal book, it is called posting. Recording in the journal is called journalizing, and from journal, when the transactions are posted, that is called posting. And after classification, the next comes summarization. This summarization takes place towards the end of the financial year, and in that, the first step is preparing trial balance, taking up the balances of all the ledger accounts and placing them and writing them in one statement, which is called trial balance. Trial balance becomes the base and the foundation for the financial statements or the final account. And there are 2 financial statements, income statement and the position statement. Income statement is a statement which is prepared to ascertain income in terms of profit or loss. There are 2 income statements, trading account and profit and loss account. And second is position statement, which is called balance sheet. Balance sheet is prepared to depict the financial position in terms of assets which are owned by the business and liabilities which are owed to outsiders, which a business has to pay to outsiders. So this step is called summarizing. After summarizing the same financial information in terms of profit or loss and balance sheet, that is the financial position, these are analyzed, these are studied in depth. Each and every element of the financial statements are analyzed, are crystallized. Everything is seen from the future improvement point of view, from the point of view of finding out that what can be done to minimize, to reduce the cost, how to reduce the expenditures, and how to increase the profit margin of the business. And then this analysis is done in such a presentable form that is called interpretation. Simple 2 digits of 10 crore doesn't make a sense unless and until it is interpreted in such a way so that the financial information is communicated, is informed to the users of the financial information in such a way that it becomes easy and simple for the outsiders, for the interested parties and the users to use that financial information. So this was all about the accounting process, and let us take up the last topic, that is branches of accounting. There are three branches of accounting which are famous. The first one is financial accounting. First one, financial accounting. Second is cost accounting. And third is management accounting. Financial accounting is the branch as which we are doing, which records the financial transaction and events. After that, it summarizes and interprets the result before communicating the result to the masses and to the users of it. And financial accounting also determines profit or loss. It depicts the financial position of the business also for one accounting year, for 1 year, and for preparing, for calculating the profit and loss. The business prepares through financial accounting income statement and position statement for the financial position. The second one is cost accounting. Cost accounting is concerned with calculating the cost of the products, of the goods, cost of the operations, cost of the activities. It is that branch of accounting which deals with recording cost, classifying cost, summarizing cost, analyzing cost, communicating cost. It is that part of accounting which deals only with the cost. And lastly, management accounting. Management accounting is that accounting which consists of, in totality, everything which is done in financial accounting and the cost accounting. It relates to the funds also, the finance also. It relates to the cost also and profits also. As this accounting helps the management in taking the decisions, in making the decisions for the future, it can be said that management accounting, though it's a recent developed accounting, but it is the major accounting, because it is the group of the manager which is called the management. They take the decisions for the future. They make the plan for flourishing the business in the future. So here we come to an end of this class. You might have purchased the books, so please read whatever we have discussed today. So the class gets over. Thank you. Thanks a lot.